The markets are down again today. Yesterday was a wild day. We put a video out there. Go check it out if you want. And also subscribe to the channel because we put a lot of videos out. We're the fastest finance channel to reporting videos, recording them and putting them out there. So the market's down a lot this year. And that's kind of a new thing for those of you who have been around, who have not been around before 2008 or 2009. Remember, we're supposed to have bear markets. They happen regularly. I don't really consider the COVID crash a bear market because it was so fast. It was kind of like, what a joke this is. And we went to massive all-time highs. We went, I think, almost 40 or 50% higher than we were at the pre-COVID high. So what I want to do, though, is compare this year to other years. Now, first things first, this is my stock market GDP ratio. If you watch any of our videos, this is updated as of a few minutes ago. I just put it in here. We're still 55% overvalued, which is way better than what we hit last year at the peak of 107. So it is getting better, but it took the market going down a lot and the GDP going up a lot. Inflation is helping GDP go up, the nominal GDP rate going up, which will naturally make the market in and of itself more valuable because, as Warren Buffett says, the stock market to GDP ratio is probably the most reliable metric at any given moment to show you where we stand in terms of valuation in the market, okay? That's wonderful. But one of the benefits of inflation is it's going to drive GDP up a ton, right? And that's a great benefit. Look at it this way. 2017, GDP was about 20 trillion. And look, even in 2021, 4 years later, it was only 22 trillion. So it only grew about 10%. Now look, in the last year and a half, it's gone up how much? 15%? Whatever the number ends up being. It's a big jump. Inflation has helped that because when costs go up, everything, the dollars all go up. All right. Now, I'm going to pull up our software. We're going to look at the S&P ETF this year to date. So look at this. Guys, we have a high of 480 in the last year. So you go down, you rebound a little bit. You go down, you rebound a little bit. You go down, rebound a little bit. Go down, rebound, go down. And I remember when this was happening, everybody said, oh, it's over. We hit a bottom here. Let's roll. And if you go watch my videos in the past, what did I say? We have not hit a bottom. We're nowhere close to the bottom. We've now seen these levels start getting hit again. And I'm not saying, see, I told you. I will tell you, see, I told you, when the S&P is in the low 2000s, which I think it very well could hit. Is it a guarantee? No. But I'd put a 30 to 50% chance of that happening by the end of this cycle, okay? Now, let's go look at other times in the past when we had crashes. So I'm going to start with January 1st, 2007, and I'm going to go to 12/31/2009. So guys, look at this chart. So again, you have a topping, down, rebound, down, rebound, down, rebound, down, rebound, crash. Okay. Look familiar? Guys, nothing goes straight down and nothing goes straight up. And if something goes straight down or straight up, it's usually some sort of indication that we're being exhausted. And I remember when the COVID crash happened, I had a short on the S&P. And literally it just kept going down, down, down. I got beyond lucky. There was no skill involved whatsoever. I exited my S&P short within 2 days of the low. Complete dumb luck. I will never take credit for that as me being a skilled person. It was complete dumb luck. All right, let's go look at the 2000 crash. So I'm going to go to January of 2000 to the end of 2003. Ready? Topping, down, rebound, down, rebound, down, rebound, down, rebound, down, rebound. Do you see a pattern forming here, guys? This is what happens. Now, what drives this going down? Very simple, valuation. And I'm going to keep going back to this chart. So this chart is going to be something I talk about in a lot of videos in the future because this, to me, is an indication of where we want to be in terms of what we want to look at for the future. So these returns do not include dividends. So I want to make sure you do that. And for those of you who belong to our software, we will be putting this on our software so you can see it every single day. We will update it probably weekly. That way people can see where we stand in terms of valuation at any given time. Now, we're at 1.443 ratio in terms of the stock market to GDP. How high is that? Well, it's not as high as we had at 1.923, But go back to 2000. The peak of the 2000 bubble, nothing had fallen yet. The peak, we were at 1.461. We're currently at 1.443. So basically we were at the start of the crash of 2000. We have a lot longer to go. Valuations were insane. Why? Largely driven by low interest rates. But what's happened in the last year? Interest rates have skyrocketed. And the Fed came out yesterday and said there's no indication that they're going to stop raising. They just said, hey, we might be a little more conservative in raising interest rates. You're not going to be as aggressive about it, which is great. More power to them. If it were up to me, guys, I'd make interest rates 7%. And that's why people would shoot me in the streets. Because to me, interest rates should not have been this low for this long. It's just kicking the can down the road. That's all you're doing. And unfortunately, the Fed chair is supposed to be an independent person who is not influenced by outside matters. And guess what? He is. Anybody would be. You're being blamed for so many things. People hate you. The president's blaming you. The president's doing this. People are doing that. It's a hard job to have. I think Jerome Powell is a very intelligent man who knows what he's doing, but he's not going to do the things he knows he has to do. These things he's doing are just purely a reaction to the people out there. And right now, inflation is the number one concern in this country. So what's he doing? The best way to fight inflation is raise those interest rates. But from a perspective of the stock market, it will be harder. And I know you're looking at me going, oh, come on, Paul, we're not going to fall. Go back or watch our last videos. Go watch the videos where we talked about all these individual hype stocks that we said should fall 80, 90% or more. They did. Go look at our past videos about people saying this isn't even possible, and it happened. Now, I'm not saying I'm some genius. All I'm sitting there saying is my job is to stand here and say, based on what I see, what does it mean about today and the future? And based on these numbers here, you can't expect very good returns. If on average, the 10-year returns at any given time are 6.6%, not including dividends, when you're undervalued, it's 9.3%. Makes sense. The less you pay, the higher returns. When you're overvalued, the average is 2.3%. Again, it makes sense. The more you pay, the less your return. But the scary part is this. When you're 30% overvalued or more, and we're currently at 55%, the average return over the next 10 years is a negative 0.1%, not including dividends. So with dividends, you'll be back to like 1.5%. But we're at a very high level. This is only 30% over. We're at 55% over. And yes, that's a lot better than recent, 107%. I get that. It's a lot better, but it's still overpriced significantly. And we have to get to the point where not everybody thinks they're an investing genius. We need to get to the point where people have given up on Apple and Tesla. We have to get to the point where the kid next door isn't making a lot of money off crypto and all these stocks he just buys randomly. That is where we need to get to. The major component of investing is a psychological aspect. A great book, The Psychology of Money, talks about how our mentality and our emotion is going to be what drives us so much in terms of money decisions. And for me, I'm going to look at, I want to wait till people are telling me, like the Peter Lynch story, you shouldn't own stocks. And that will happen. That's where we need to get to in order to have another secular bull market. So how expensive is this market? Well, like I said, this ratio is 1.443. The lowest point it got, August of 1983. That's when the secular market hit its all-time low. August of 1982. Look at this, guys. 0.329. Almost 1/5 this level. That'd be the equivalent of basically the stock market today being around 800 or 900 in the S&P. I'm not saying that's going to happen, but what I am saying is we have to get to very low levels for us to have another secular bull market. We have to get to the point where literally Barron's writes the article, The Death of Equities. That's what it takes for really long growth. And look what happened from 1982 to 2000. Look at the S&P. It was 109 in June of 82. And look where it got in 2000. It hit 1468. But look at the 16 years before 82. 1966. Look where the S&P was. 90. 1967. 100 in 1968. And in 1982, it was at the low of 1982 was at 109. 109. And look at where valuations were back then. Slightly overvalued. Slightly overvalued. But guys, that's where we need to get really massive, massive, massive gains in the future. But remember, dollar cost average every single month, whatever your decision is, quarterly, weekly, monthly, yearly, whatever it is. And as the market goes down, you will buy at lower prices. As long as you believe in the US economy, this will be a very tried and true way to make money in the market long term. So again, you guys need to follow us, subscribe to our channel. We do videos like this all the time, very knowledgeable. And I guarantee when you watch 4 or 5 of our videos, you will walk away with a better understanding of money, because the more you learn, the less you fear. Thank you very much.